It's most likely a bit of a front-loaded year if you want to think in yearly terms. It could well be that we're in a front-loaded performance here. But I think, again, if you're an equity investor, what's really important is the cost of capital, because that affects your discount rate, that has an immediate impact on your stock price. And the growth picture is more of a long-term issue, I think. And again, coming back to the point I just made, more of a bumpy road and a bit of a deceleration in economic activity might be actually a very welcome development at this point, because I think that will then help the deceleration on the inflation side in a much more rapid manner.
So we get falling interest rates, we get falling yields, which encourages investors back into equities. But we still have, don't we, in the backdrop, the broader fear around what's going on in the financial plumbing and the banking sector at this stage. And Jamie Dimon hasn't helped by telling everybody in his most recent letter that he's concerned that this is not done yet. So as we watch the UBS AGM and the whole Swiss story play out here, how worried are you or otherwise about there being further second round effects from what we've seen?
Well, we think that there will be more effects from this banking woes we're seeing, especially in the United States, and that really comes through the credit cycle. Because I think as a bank you have a strong incentive to be more cautious on your lending activity, to shore up liquidity on the asset side and make sure that your liability side remains very healthy. So I think, yeah, we should expect more tightening there, but I think that allows the Fed on their monetary policy side to take a sort of a step back and let the market do sort of the action. And I think that's what we're seeing at the moment. So, and yeah, I think there's reasons to be worried, but worries should always be in context with where do asset prices stand. And when I look at the valuation picture today, I think there's still a decent discount, so we can live with some uncertainty at this point. And I think that's the important piece here.
Do you think there is still valuation upside in tech? I mean, just following on to Jeff's point, talking to a number of investors over the last couple of months, it seems like the U.S. tech rally has been a really painful trade for a lot of asset managers who were caught wrong-footed. They weren't positioned for it. And if you do still see a value opportunity, maybe it's worth chasing the rally even if you haven't been in it so far.
Well, I think the difficulty has been the narrative switched fairly swiftly. Last year was all about rising interest rates, capital cost, big drag on valuation. And then suddenly we had this sort of turmoil on the banking side, and the interest rate development sort of started to decelerate and then took quite a hit over the last 4 weeks, and that sort of spurred this trade on the growth side again. I think when I look at the valuation picture, it really all depends on what you think over the next 3 to 4 years will be a more normalized environment, and I still think even longer dated treasuries at this point maybe are 50, 60 basis points above what we would consider an average longer dated yield.